Good afternoon, everyone. A nice rainy afternoon, a hot cup of coffee, and coming together of intellectual minds. The perfect blend for another Triple E Wednesday. As we begin the 11th session of the Master Knowledge series, the intent today is to understand the financing side and the legal obligations entailing. As company secretaries, whether in employment or in practice, moments would have come up where our companies or clients would have sought our suggestions and support in pursuing foreign sources of funds. Foreign Exchange and Management Act, tricky as it was during our days of learning, requires a much more focused approach to render the right guidance to those seeking. All of that and what we have is the topic for today's webinar: ECBs, trade credits, and structured obligations. To begin with the definitions of these terminologies, I'll begin with the first one, the ECBs. External commercial borrowings, the commercial loans raised by eligible resident entities from recognized non-resident entities. And as the Reserve Bank puts it, should conform to parameters such as minimum maturity, permitted and non-permitted end users, maximum all-in cost ceiling, and so on. The second part of the topic, trade credits. The credits extended by the overseas suppliers, banks, financial institutions, and other permitted recognized lenders. Purpose being for imports of capital or non-capital goods permissible under the foreign trade policy of the Government of India. The third part of the discussion, structured obligations. Now, structured obligations, although have not been accorded any dedicated meaning by the RBI, attempts have been made to duly regulate them. But to accord them a meaning and have better conceptual clarity, structured finance obligations are a special type of investment product, which are built by combining different financial assets and instruments. These unique products are mostly used by corporations, governments, trusts, to achieve very specific financial goals. Apart from the Foreign Exchange and Management Act, the RBI has issued master direction, external commercial borrowings, trade credits, and structured obligations, rolling out provisions to be followed and compliance is expected to be made. And to guide the way, we have CS Bijoy P. Polipra, an advocate and commercial arbitrator by profession amongst us. He's an advocate, a qualified company secretary, an accredited commercial arbitrator, insolvency professional, and a registered valuer for financial assets. With over 21 years of experience in corporate and related laws, he is not only a legal expert, but also a passionate corporate trainer, accredited by the CSIA, and is also holding the position of independent director at Maricar Motors Limited. He serves as the founder member and general secretary of NCLT Kochi Bar Association and as a managing committee member of the Trivandrum chapter of the SIRC of ICSI. Adept in corporate laws and connected litigations, he frequently appears before the Supreme Court, NCLT, tax tribunals, and SAT. He possesses hands-on experience in corporate insolvency, valuation of securities and financial assets, mergers and acquisitions, foreign exchange laws, ECBs, arbitration and conciliation, and the list is endless. But today, we have him amongst us to be benefited from his words of wisdom in the arena of external commercial borrowings and trade credits. And we welcome him at the 11th session of EEE 4.0 Master Knowledge series. Thank you so much, sir, for being with us. Before moving forward, I would request all the participants to raise their queries on the links shared, and we would be taking it up with our speaker after the session.
So thank you very much. Thank you very much for the nice introduction. So let me begin straight away with the topic. Today, we are going to discuss, as slightly introduced, we will be talking on 3 topics. Basically, it is called, everything is encompassed in the single term called borrowings. And we will be discussing about ECBs, then trade credits and structured obligations, but in a reverse manner. Like we will discuss first trade credits, and we will then discuss structured obligations, and then we will go to the ECBs. And before that, before getting into that, I would like to give you an idea about what is the nature of these transactions called capital account transaction and current account transaction, to get you an idea about it. So let me share my screen first so that we will go as per the screen. And as you rightly pointed out, any queries can be raised at the end of this session. Is my screen visible?
Yes, sir.
Okay, thank you very much. So moving on, as I had mentioned, when we are talking about the ECBs or trade credits or structured obligations, we have to see in which category it is falling into. When it comes to applicability of FEMA, then we can largely segregate this into two. One is capital account transactions, and the other one is current account transaction. So let us understand these two key terms in full before getting into our main subject topic called ECB as well as others. So when we are trying to understand the key terms, we can largely say that current account transactions are allowed by law unless it is specifically prohibited. Whereas a capital account transactions are generally it is prohibited until permitted. So we can largely say that for current account transactions, we don't need any permission specifically or per se. You can straight away carry out the current account transactions to an extent unless it is prohibited. Whereas when it comes to capital account transactions, these are generally it is prohibited. And you need to invoke it either under applicable routes like automatic route or approval route to enable it. And these capital account transactions, we will study in a little bit detail. So first of all, we will see what is a current account transaction is. It is actually stated that all transactions which are not capital account transactions are current account transactions. That means current account transaction is actually detailedly defined. Similar to that, current account transactions also defined in this law. So transactions that are specifically included, even though they are capital in nature, there are certain transactions which we can say that it is actually capital in nature. But still, it is classified as current account transactions in the definition of the FEMA, like 2J of the FEMA. We will see the definition of the current account transactions first. So as I remind you that all the transactions, though it is sometimes it is of capital nature, can be classified as a current account transaction also. These are the definition of the current account transactions, like payments in connection with the foreign trade, other current business services, short-term banking and credit facilities in the ordinary course. So any payment towards import or export, or any service extended to a person who is residing abroad, as a resident outside India, and short-term banking and credit facilities in the ordinary course is also classified as a current account transaction. So short-term banking and credit facilities technically is a capital account transaction nature one, because it's creating a liability or asset for a person who is resident in India or abroad. Though it is that kind of category, this definition encompasses short-term borrowings and credit facilities within it. So payments due as interest on loans and as a net income from the investments, like interest on the loans, dividend on the investments, these are actually classified as a current account transactions. And remittances for living expenses for parents, spouse, and children residing abroad. Similarly, expenses for foreign travel, medical care of the parents, spouse, or children residing abroad, all these are called current account transactions, in which you can see that except for the colored portion, the rest of are actually not creating any kind of asset or liability for a person who is resident in India or a person resident outside India. And when it comes to definition of capital account transactions, this is actually we have to understand in a bit detailed manner to understand the concept of ECB in full. So transactions that alter assets or liabilities, including contingent liabilities, outside India of a person resident in India. Due to a transaction, a person resident in India is creating any kind of assets or liabilities abroad, or vice versa. That is, a person resident in India is outside India is creating an asset or liability in India, including contingent liabilities, that is largely classified as capital account transaction. And as per the definition, it is also stated that it also includes transaction referred to in section 6 subsection 3. But Section 6 subsection 3 is now omitted from the FEMA. And so that even though it is included in the definition of the capital account transactions. So to largely understand this concept, if you are through a transaction, an Indian citizen or Indian person resident in India is creating an asset or liability outside India, or a person who is resident outside India is creating an asset or liability in India, these are called capital account transactions, wherein this concept is not there in the current account transaction because that is not creating any asset or liability. So certain important aspects with respect to capital account transactions. First of all, it is a transaction between a resident and a non-resident. And the place where the asset is held or liability is incurred is also important. From where, which country you are creating the assets or which place you are creating the liability is an important aspect while analyzing or understanding a capital account transactions. Then there may be, it's like when you are creating a liability, that means availing a foreign loan or foreign credit, you may have to provide security for that particular loan, creation of or change in the value of the asset or liability on account of that transaction. And residence of the person affecting the residence in FEMA, the entire invocation of the section comes into play based on the residentialship status of the person, whether the person is a resident in India or a non-resident or a person of Indian origin or OCI. So these are so your residentialship status or the transactions between a resident or non-resident is actually an important parameter to determine a capital account transaction. It continues, any person can sell or draw foreign exchange for capital account transactions subject to conditions or prohibitions. That means you can draw the foreign exchange from an AD category 1 bank to carry out a capital account transactions, but there are certain prohibitions or conditions. First of all, RBI or central government shall specify, as per the Act, shall specify the transactions which are permitted and limits up to which drawal can be made. Similarly, RBI or central government will make regulations for the permitted transactions. We know that there is foreign direct investment policies are there, RBI directives are there. Foreign direct investment policies are being made by central government, wherein RBI is putting out in the list for the master direction. So through circulars, they are regulating these kind of transactions. And if you see the classes of capital account transactions, which is applicable to person resident in India, from Indian perspective, what are the transactions which can be classified as a capital account transaction? Investment by a person resident in India in foreign securities. So you are creating an asset abroad that is actually an investment which is actually classified as a capital account transaction. Foreign currency loans raised in India and abroad by a person resident in India. So if you are availing a loan in foreign currency, that is actually our today's discussion topic. Whether in India or in abroad by a person resident in India, that is also classified as a capital account transaction. Then transfer of immovable property outside India by a person resident in India. If you are holding a property, more property outside India, and you are buying or selling or transferring or conveyancing it, that is also classified under the capital account transactions. And you may have to issue guarantees, structured obligations. When we will study the structured obligations today, we will study more about these guarantees. And when a guarantee is being issued by a person resident in India in favor of a person resident outside India, that is also a contingent liability, or it can be called a structured obligations. That is also a kind of a capital account transactions. Then export, import, and holding of currency notes is also a capital account transactions. And loans, overdrafts, that is borrowings by a person resident in India from a person resident outside India. So these are the large classifications of a transaction from a person resident in India perspective. We will now see what are the transactions from a person resident outside India perspective. These are the ones. So investment in India by a person resident outside India, like issue of security by a body corporate or an entity in India, and investment therein by a person resident outside India. So a body corporate is actually issuing shares to a person resident outside India, and he is investing into that. And investment by way of a contribution by a person resident outside India to the capital of a firm or a proprietorship concern or an association of person in India, subject to the restrictions in the concerned regulations under the FEMA. and acquisition and transfer of immovable property in India by a person resident outside India. So a foreign national or an NRI or a non-resident is acquiring property or transferring it. Similarly to the other one, issuing a guarantee to a person in India by a non-resident. Import or export of the currency. It's all other two sides of the same coin. So it will almost see deposits between a person resident in India and a person resident outside India. So that is also coming under there is a separate regulations for dealing with the deposits. That is actually governed by the deposit foreign exchange management deposit regulations. And foreign currency accounts in India of a person resident outside India, like we have FCNRB accounts, NRE accounts, who are actually being operated by person resident outside India. That is also into the current account. It's not a current account, it's a capital account transaction. And foreign currency accounts in India of a person resident outside India. Sorry, remittance outside India of the capital assets in India of a person resident outside India, and derivative contracts. These are the classification of the capital account transactions from a person from these two perspectives. One from the perspective of person resident in India, and other from the person's resident outside India. So now we will get into our main topic with this understanding that borrowings or any kind of import or that any trade transactions, trade related transactions, or any liability creating transactions like this external commercial borrowings are largely classified under the term borrowings, which, as you can see from the slide, we will follow the same sequence for trade credits first. Then we will discuss about structured obligations, and then we will finally end up the presentation with external commercial borrowing. So now we will understand what is a trade finance. We know that for a trade to happen, there are actually multiple stages. It from the production or arrangement of the raw materials or manufacturing of the product, then shipment of the product, that means export, import, then finally that selling of the finished goods. Then comes the money to be collected to the source, and this is actually requires a lot of financial arrangements between the parties. So this trade finance is basically allowing the participants to manage the capital required for the trade. Because when you are an Indian perspective, you are dealing with a person who is in abroad, who is an unknown person or an unknown landscape. You may not be sure about how to recover your money from that particular person. And otherwise also, somebody is actually exporting the goods from India, that is importing to their country. They also not aware about how to, or they're not sure about how to recover this money from the seller or purchaser in India. So this is a part of the trade finance, which we will detailedly analyze. So fraction of international trade happening in cash in advance. So I am buying something from abroad. There is a rarest of the rare circumstances only I will send the money in advance. If I am sending the money in advance to an unknown person or to any other entity, I am not sure whether I will get the goods which or service which I was desired to achieve. There is no guarantee in that. So only in very rarest of the transactions, the cash advance transactions will happen. So trading systems need actually a well-defining financial systems providing trade loans and guarantees for traders. So whenever a trading is happening, this should be backed by a proper banking system or a financial system, which is extending certain kind of credit to the sellers or to the buyers. And we will see who are the parties involved in a trade finance. Definitely, there is an importer. Importer can be a person resident in India or a person resident outside India, depending upon from what you are importing. And there is an exporter will be there. There is an importer is there. And for an importer, there is a bank. Exporter is also having a bank. And there will be a correspondent bank. And then once all these things are arranged, then you have to clear the regulatory barriers, like you have to deal with the import customs, you have to deal with the export customs, and then you have to deal with the several agents like freight forwarder, insurer, pre-shipment inspection, shipper, document courier. All those things will come as a part of this trade finance. So it's a combination of all these things will make a trade happen. And there is actually, if you divide these trade into one, you can see the pre-shipment finance and then post-shipment finance. We will see that a little bit in detail. So this pre-shipment trade finance will enable exporters to procure raw materials, carry out the manufacturing process, package and forward the finished goods, etc. For this, for procuring raw materials or to manufacturing process or to packaging and forwarding, you need funds. And these funds can be given by a person. It can be provided by a financial institution, or it can be even provided by the buyer side of it. And you have for that you have packing credit, and you can even collect the advance against the trade receivables. And that is how the pre-shipment finance works. We will see the post-shipment finance now. So when it comes to post-shipment finance, loans or advances or any other credit to importer of the goods and services from India by a banking financial institutions. Basically, these are loans and advances to the exporter of the goods from India by banks or financial institutions. And it is extended after the shipment of the goods or rendering of services to realization of the export proceeds. Once these goods are exported, it is very important to recover it or realize it, whether it is a goods or service. And this is a part of the post-shipment finance. And it is granted up to 100% of the invoice amount with a recourse against the exporter. So a goods valuing certain dollars, say $100, the maximum credit you can avail against that particular invoice is $100. It is being extended by the exporter's bank, or it can be by the supplier, by the buyer himself. So products of, if you see the products of trade finance, this is called unfunded trade finance, like bank guarantees, corporate guarantees, personal guarantees are there. And funded trade finance is also there. Actual money is coming into the picture. So these are the two products of trade finance, unfunded and funded trade finance. We will see what is an unfunded trade finance is. It is basically focused on credit enhancement or support, and it does not offer liquidity to the exporter. Means there is no actual remittance of the money, but it's only giving a comfort. Like it is actually giving a support. Rather, it supports the transactions by guaranteeing the performance of parties in their different roles. He will ensure that the other part is properly performing. The fund is flowing to the exporter after exporting the goods. A bank or intermediary will be there to ensure that the funds is being collected from the importer's bank and giving it to the exporter's bank. And to that extent, there will be a guarantee or there will be a support from this institution, and it is actually called unfunded trade finance. When it comes to funded trade finance, it is basically focused on providing liquidity. The interest is to provide maximum liquidity by giving actual funds to the traders, and focused on risk mitigation and helping to settle conflicts. Basically, you know that letter of credits or letter of comforts, all these are actually, or bank guarantees are actually in these aspects, and where accelerate the payment from the importer, it accelerate the payment from the importers, and it mitigates the supply or performance risk of the exporter. Here, in this kind of transactions, the exporters or exporter is largely depending on the other side bank or his own bank to ensure that the supply or performance risk is mitigated to the minimum, to the maximum, and ensuring the receipt of the goods and affecting the payment. So these are called funded trade finance, and we have seen already what is unfunded trade finance. So if you see the type of trade finances, this is actually in the ECB policy, you can see. Trade credits are largely called buyer's credit, supplier's credit, factoring, forfeiting, letter of credit, cash advances, open account, and receivable discounting. These are the methods of trade finance prevalent in international trade. And we will see the trade credits, especially the first two, buyer's credit and supplier's credit in detail. And there is actually the mode of trade finance, which I am not intending to go through that due to the paucity of time. This is actually trade credit. If you largely see the definition of the trade credit, it is a credit extended by an overseas supplier or a bank financial institution or other permitted recognized lenders for a maturity for import of capital or non-capital goods permissible under the foreign trade policy. So it is a credit extended by the overseas supplier or a bank or a financial institutions or other permitted recognized lenders for the import of capital goods or non-capital goods. So these are the criteria. One is that it can be used for the import of capital goods or for an import of non-capital goods, and that import of these goods should be permitted under the foreign trade policy. And this extended facility is based on certain maturity, means the repayment. And depending upon the source of finance, trade credits includes supplier's credit and buyer's credit. Who is extending this credit, and whether it is from the bank or whether it is from the suppliers, depending on this, the other two trade credits or supplier's credit or buyer's credit can be seen. So we'll see what is buyer's credit. Buyer's credit is a loan for payments to import into India. It is basically extended by importer from a bank or financial institutions outside India for a maturity of less than 3 years. So to import something to India, the importer is arranging a facility from a foreign bank with a condition to repay the same within a period of less than 3 years' time. So arrangement by a financial institution of another country, that is exporting country, enables the buyer to make payments to their supplier through the credit arrangement. So if a financial institution of another country, that is exporting country, enables the buyer in India to make payments to their supplier. So we are taking a liability, creating a liability abroad for purchasing something from a person who is residing abroad. And risk of realization of the amount falls on the financial institution. Here, in case we are not, the Indian buyer is not paying that, the risk of recovery is on the financial institution, not on the foreign supplier. Now we will see the supplier's credit. Supplier's credit is only a little bit different from it. Conceptually, it is same, but the party who is extending is not a financial institution, it is a supplier himself. So it is also a credit for imports into India, extended by a overseas supplier. So here, the importer is still an Indian citizen or a person resident in India, and instead of financial institutions is extending that facility, here overseas supplier himself is extending this facility, and financing arrangement, the exporter of foreign country extends credit to the buyer of India to finance the purchase of the buyer. That means it is an extended credit period. They are actually financing the Indian buyer by extending a credit. And credit risk to be borne by the supplier who made a de-risk by availing the cover from the insurance agencies. So here, in case of a supplier's credit, the extender of the loan is a supplier of the product, where in case of a buyer's credit, it is actually given by a financial institution or a bank abroad. In case of a buyer's credit, the responsibility or the risk of collecting this money from the Indian counterpart or Indian buyer is always from the bank itself or financial institutions, where the supplier is actually not shouldering that responsibility. Where in case of a supplier's credit, there is no financial institution, so supplier is actually giving, and they have to mitigate the risk by availing an insurance policy. Hope I am clear about this. Now we will see the period of trade credit and how it is actually coming under the FEMA. This is actually a short-term credits or borrowings which we have learned at the time of defining the current account transactions. It is not at all falling within the definition of the capital account transaction till a particular threshold is met. We have learned that it is against a maturity. If that maturity period is changed, this will become a current account. From a current account transaction, it will become a capital account transaction. Till then, it is actually a short-term borrowings from banks or financial institutions abroad in India, which is largely classified as a current account transaction. So we will see the concept of minimum average maturity period, MAP, in which the period of trade credit, import of capital goods up to 3. If you are importing the capital goods, the minimum average, so not maximum, minimum average maturity period is up to 3 years. Up to 3 years means not 3 years, like 1 day before the third year. Import of non-capital goods, if it is a non-capital goods, it is up to 1 year or operating cycle, whichever is less. And there is an exemption or as additional for benefit for the shipyards and shipbuilders, irrespective of the nature of the goods, whether it is capital or non-capital. they will get up to 3 years time period, minimum maturity, average period. And when it comes to buyers or suppliers credit for 3 years and above, it comes under the ECB category. If the maturity period or the loan period is going beyond the period of 3, then it's actually an ECB, not anymore a current account transaction. So routes and amount of trade credit, that there is a cap for the amount also. These two, there are two routes. One is automatic route, another one is approval route. As the name says, approval route does not need any prior approval from the Reserve Bank of India, but an approval route requires up to 50 million US dollars or equivalents per import transaction. It is an automatic route. If you are going beyond 50 million or equivalent per import transaction, you are coming under the approval route. For oil and gas refining, marketing, airline and shipping, the limit is $150 million. So beyond that, it will be again approval route. So these are the routes and amount for the trade credits. So one thing we have to remember that 3-year time period is actually a determining factor. The 50 million is also another determining factor, whether it is to be considered under the ECB or whether it is outside the ECB. So trade credits framework we will see. Like trade credits for imports into India can be raised in any freely convertible foreign currency. We can see that FCY dominated trade credits or Indian rupee dominated trade credits. So these can be raised. These trade credits can be raised either in a foreign currency or it can be raised in Indian rupees. So there is an all-in cost ceiling. All-in cost ceiling means we are actually having a separate section for the all-in cost. I will explain that in detail at that point of time. All-in cost means all the expenses that are to be borne by the borrower for availing this particular credit facility is called all-in cost ceilings. If it is a foreign currency denominated trade credit, the current benchmark, the interest rate is benchmark rate plus 300 basis point spread. And in case of an INR denominated trade credits is actually benchmark plus 250 basis point spread. And we know that when a when a money is being borrowed from a foreign source, there is a risk of currency rate fluctuations. To mitigate the currency rate fluctuations, we have to protect it through a process called or an instrument called hedging instruments. So there is a hedging provision is there. In case of a foreign currency denominated trade credits, it is required to follow the guidelines for hedging issued by the concerned sectoral or prudential regulator. And such entity shall have a board-approved risk management policy. So if it is a foreign currency denominated trade credit, you need to have a hedging policy. If it is an INR denominated trade credit, overseas investors are eligible to hedge their exposure in a rupee through permitted derivative products with the AD1 bank in India. If it is a INR denominated trade credit, the risk is mostly on the overseas investors who need to protect their interest by protecting it through, again, a hedging by entering into derivative products with AD banks. So there is a hedging requirement is there. And whether we can change the currency of the borrowing in due course. So if it is a foreign currency denominated trade credit, that means you are availing it in a foreign currency. Change in trade credit from one freely convertible currency to another freely convertible currency is permitted, like dollars or euros. That kind of changes are permitted if it is a foreign currency denominated trade credit. Whereas it is a INR dominated, rupee dominated denominated trade credit, it is actually change in currency from any to any foreign currency, any freely convertible foreign currency is not permitted. So currency change is permissible only if it is a FCY, that to another AFC. So when you are availing a trade credit from a foreign source, the lender have to get certain kind of guarantee in the form of security. So the bank guarantees may be given by the credits on behalf of the importer or resident in favor of the overseas lender. So bank guarantees of the can be given by the AD bank. on behalf of the resident in India in favor of an overseas lender, wherein bank is guaranteeing the payment. Bank guarantee not to exceed the trade credit amount. That means the total liability of the bank should not be more than the liability against the trade credit, and bank guarantee cannot be beyond the maximum permissible period of the trade credit. We know the period which we have already seen, the maturity MAMP time periods, and that the bank guarantee should also be coterminous with the maximum permissible period of the trade credits. So a little bit more on the security for the trade credits. Importer may also offer the security of, there is an option to offer the security by creating charges over the movable or immovable assets. If it is a cess land, it is not permissible. Otherwise, movable or immovable assets can be mortgaged or hypothecated. And a corporate or personal guarantee can be given apart from what we have discussed before, the bank guarantee. And the creation of charge. When you are creating an encumbrance over the property, you may have to create charge. For that, there should be a security clause in the agreement in which actually the importer should be allowed to create a charge. And if there is an existing lenders for the particular borrower in India, the NOC from the existing lenders is a prerequisite. And this arrangement, whatever the charge creation arrangement, whether it is movable or immovable or whatever the guarantee you are giving, that should be coterminous with the trade credit. And in case of invocation, that means unable to repay the borrowed amount or the trade credit. In that case, the foreign lender will invoke it, either the bank guarantee or the corporate guarantee or personal guarantee, or they may even take over the immovable assets. In that case, total payment towards the guarantee should not exceed dues towards the trade credit. And it should be in adherence to FEMA acquisition and transfer of immovable property in India regulations, and for FEMA, Foreign Exchange Management Transfer Issue of Foreign Security Regulations 2017. This is because you are giving immovable property invocation that should be in compliance with the other two regulations. And sometimes it will be convertible also, that we will discuss. So when it comes to the trade credits, there are certain reporting requirements for the trade credits. And first of all, the responsibility. Who is primarily responsible for adhering to the trade credit policy is definitely it is the importer. And apart from that, authorized dealer category 1 bank who is involved in this ensure the compliance with applicable parameters of FEMA. They is actually supposed to look into. They are actually not fully responsible for it. Responsibility is primarily or fully on the importer. And when it comes to documentation side of it, the trade credit arrangements or loan agreement to be executed, there should be an agreement between the parties defining these terms, the security part of it and the invocation part of it, and AD to check and confirm the documentations to their satisfaction. And authorized dealers should ensure compliance with the minimum average maturity period, which we have seen before. And the reporting is actually by the banks. Reporting to be, there are monthly reporting as well as the quarterly reporting. In case of a monthly reporting, they are actually giving a consolidated statements of all the entities, trade credit drawals, utilization, repayment in a consolidated manner. And quarterly also there is a reporting from the end of banks, and details of issuance of the bank guarantee by the banks will be covered in the quarterly reportings. So these are the basics about the trade credits. And we have seen that trade credits beyond a specific period will fall under the purview of the ECB. So this is basically called the trade credits, which have discussed about the buyer's credit. We have discussed about the supplier's credit and how how the security can be invoked, how the minimum average maturity period works, and how it is actually classified as a current account transaction as well as a capital account transactions after a certain change in the parameters, and what are the routes available for the trade credits, automatic route and approval routes. Now we will see a slide on structured obligations. What is actually a structured obligation as far as the ECB policy is concerned. So wherein borrowing and lending in Indian INR between two residents, we know that it will not attract FEMA, because FEMA will come into play only if there is a capital account transactions or a current account transactions, as we discussed. If a transaction is happening between two residents, FEMA is out of the picture and FEMA is not coming into play. Wherein if a rupee facility, that is letter of credit, letter of undertaking, letter of comfort, by residents are guaranteed by a non-resident, no the FEMA application till the guarantees are invoked. In a situation where a resident is actually, a non-resident is giving some kind of a guarantee in the form of letter of credit or LOU or letter of comfort, that is actually again not a FEMA compliance matter till it get invoked. Till then it is only a contingent liability. Once this contingent liability getting crystallized by invoking that guarantee or letter of or the instrument, then definitely it is coming under the purview of FEMA. Otherwise, it is not. So the trigger point is the invocation of the guarantee to become the foreign non-resident is coming into picture. So when an invocation of guarantee is happening, what is actually the compliance? What are the compliances? So a non-resident guarantor means a non-resident is actually guaranteeing a resident's obligations, and that guarantee is invoked. And in that case, what is the obligations of the non-resident guarantor? Guarantor have to meet the obligations, which is he had given a surety. He need to step into the shoes of the principal debtor and release that money. So he have to release discharge the liability of the principal debtor or borrower, the payment out of the rupee balances held in India. Suppose he is having an account, a balance in the NRO account, non-resident ordinary rupee account. He can use that balance to settle the or discharge the liability of the resident. Or he can bring money from abroad by remitting funds from abroad, or get it debited from the FCNR B account or non-resident external rupee account. So there are three modes through which he can discharge this liability. So once this surety, that is the guarantor, who is a non-resident, is actually remitting the money or discharging liability of an Indian resident, he will definitely enforce the claim from the resident. He may enforce it by to recover the amount. He will recover the amount from the resident. Once it is recovered, the next question, whether it can be repatriated. If the first option, like payment of rupee balance is held in account, actually there is no need for repatriation and it is not possible also. Or it can seek repatriation of the said amount if the liability is discharged from the FCNR or NRE account. If discharged from the rupee account, it can only be credited to the NRO account. So it is a very simple to understand concept. If you bring money from India, from abroad to settle the money, you can take out also. If you are not bringing the money from abroad, you are using the local sources or your normal rupee accounts or NRO accounts, you cannot repatriate it. So that is called structured obligations, how it, and we will see this a little bit more detail. So being the principal debtor, there is a general permission available to the resident. That means the person who had given the that availed the benefit of this guarantee, that is principal debtor, he can make the payment to person resident outside India who had met the liability under the guarantee. There is no requirement of approval because there is a general permission is given. In case where the liability is met by a non-resident out of the funds remitted to India or FCNR B or NRE account, or repayment may be made by crediting to the FCNR B account, or amount credited shall not exceed amount paid by the non-resident guarantor. That also makes sense because you cannot claim more than what you have given. So these are about the structured obligations which is covered under this revised ECB framework. Now we have seen what are structured obligations, and we have also learned what is trade credits. Now we will get into the topic called external commercial borrowing. So as the name suggests, it is a borrowing. It is borrowing, basically a commercial borrowing. It is an external from external sources. So as the name suggests, it is a commercial borrowing from external sources. Now we will see the definition part of it, the applicability of it, minimum or average maturity period of the liabilities, and security part of it in detail. What are the advantages? What are the disadvantages, etc. So when it comes to, it's a borrowing by a eligible resident entity from outside India. So the key words are, he should be an eligible resident entity from outside India. And it should be the borrower should be in accordance with the framework decided by the RBI in consultation with the Reserve Bank of India. And I will come to the definition of it now. What is the definition says? Definition is that ECBs are commercial loans raised by eligible residents, and the money to be provided or borrowed from recognized non-resident entities. And it should conform with certain parameters with respect to minimum average maturity period, permitted end uses, and maximum in-cost ceilings. So minimum maturity period we have seen in the case of trade credits. And in case of ECBs, there are certain, now it is a negative list. Earlier it was a positive list. Now it is a negative list stating that you cannot or you should not use the money which is borrowed from abroad as a commercial loan for certain purposes. For other purposes, you are allowed. So this is basically the definition of the IBC, and it's a commercial loan, and it is raised from a non-recognized entities and should conform with certain parameters. And for that, we also have several banks in India, and there are credits available. There are strong banking institutions we have. Why should we explore an external source for a borrowing? So we have to see what are the advantages and what are the disadvantages of this ECB to understand this concept in full. So if you see the advantages, first of all, the cost of raising ECB is lower. I am taking my next slide. So ECB cost is basically lower because interest rate in many countries abroad is much lesser than the Indian source of financing. The global financial market is a much bigger source of credit, and because there are many strong banks or finance institutions or other categories of recognized lenders who are able to pump in money to the company with a lesser cost. And foreign lenders have far more flexibility in terms of providing security for ECB. That is another aspect, because in India, if your account is becoming SMA or NPA, then it is difficult for you to get any financial assistance from any financial institutions, because the RBI will step in and say that you cannot extend the liability anymore to this person because we have already become an NPA. Unless you remove the NPA or SMA status, we are not ready to lend you. But that kind of restrictions are not there for a foreign lender. That can be potentially used by the companies which are actually having stressed assets, like or facing CIRP under the Insolvency and Bankruptcy Code. And now we see the disadvantage, or other side of the coin, is that companies availing ECB reflects in the balance of payment of the country. We know that India as a country having its own balance sheet, which is actually reflecting the liabilities. So when you are taking a company is availing ECB, it will reflect in the balance sheet of the country, India, and to avoid to mitigate any kind of currency fluctuations and its impact in the financial statements of the company as well as in the country, hedging made mandatory, which will increase the cost of funds. Though in the previous slide I have mentioned that ECB, the cost of funds are lesser, but with the component of hedging added to it, it is going to be expensive. So ECB raised in foreign currency is to be repaid in foreign currency. Hence, hedging needed to avoid foreign exchange exposure. So that means, suppose if you are taking a foreign currency loan, we need the foreign currency generation to repay it properly, or you need to draw the foreign currency to repay it. For that, hedging is needed. Otherwise, depending upon the fluctuation of the foreign currency with the Indian rupee, you may end up in paying more money than you borrowed. If the other way is happening, you will be on the gaining side. But if the rupee value is depreciating, you have to shell out more money to repay your ECB. And risky to keep the exposure without hedging. It is highly risky and it is not allowed also. It's mandatory. But even if you are keeping this hedging without hedging, the currency value depreciating means that you will be ending up in a lot of troubles than you envisage. if ECB is rupee dominated, exposure risk is low for the Indian party because you are still repaying in Indian rupee only. But for the counterpart, it will be highly risky. So they will ensure the hedging at their end, which will again make it costly. So, when it comes to availability, if you see the cost side, it will almost match with the Indian interest rates. When the hedging component is also added to it. But the other side of it, the availability or the stringent norms which is existing in the country can be surpassed by availing an ECB for the entities. And we will see what are the regulations which are applicable for ECB. Section 6, subsection 3, clause D of FEMA 1999 and FEMA 1, FEMA 3R, FEMA 5R and FEMA notifications. And RBI circular on, there is a separate circular on trade credits. It is now added along with the ECB. And RBI master directions master RBI and FAQs of the RBI. And there is a monthly ECB data, which is actually published with a 1 month delay. These are the regulations or the documentations which will help us to comply with the ECB guidelines. We will now see the complete framework of the revised ECB guidelines. One is that FEMA Permissible Capital Account Transaction Regulations 2000 is having an applicability in it. And FEMA Guarantee Regulations, especially for a non-resident guarantee for domestic funded or non-funded basis facilities or facility of credit management, the FEMA Guarantee Regulations are applicable. And FEMA Deposit Regulations 2016, which I have mentioned before, the company shall not accept deposits on repatriation basis from an NRI or a person of Indian origin without adherence to the Schedule 7 of the regulations. When a company is accepting deposits, it is actually, you don't have to fully comply with the ECB guidelines if you are falling under the Schedule 7 of it. Otherwise, you will fall within the ECB guidelines, and ECB compliances are mandatory. In case of deposit regulation, though I am not covering it, it is actually requires to have a compulsory convertible instruments to be issued against this deposit, which is you have accepted under regulation Schedule 6 and 7. And FEMA Borrowing and Lending Regulations 2018. If you see, there were 3 regulations were there before, which is now merged into FEMA Borrowing and Lending Regulations 2018. FEMA for Exchange Management, Borrowing and Lending in Foreign Exchange Regulations 2000, Borrowing and Lending in Indian Rupees Regulations 2000, Transfer Issue Foreign Security Regulations Regulation 21. These 3 regulations are now merged into a single regulation called FEMA Borrowing and Lending Regulations 2018. We will now see the rules related to the ECB. Central government and RBI is actually constantly, if you see the FDI policy also, it's happening, constantly liberalizing and normalizing or regularizing the rules or regulations with regard to the capital account transactions. That's a policy of the government to liberalize it. So earlier, there were, if you see, there were 3 tracks of ECB. One is foreign currency with a minimum average maturity period between 3 to 5 years. And foreign currency minimum average, that it is not FCB, it is FCY, that minimum average maturity period of 10 years. And the third track was rupee dominated minimum average with a minimum average maturity of 3 to 5 years. Now, these 3 tracks are combined, and there are only now two types are there. One is foreign currency denominated ECB, and second one is rupee denominated ECB. So we can largely say that now that ECB can be availed either in foreign currency or it can be availed in rupee dominated that ECB. We will see the routes of the ECB now. As we have seen before, it is called automatic route and approval route in this case also. We will see these 2 routes in a little bit more detailed manner to give you an understanding about what it is actually meant to be. And in case of an automatic route, no approval of the Reserve Bank of India is required, where AD Bank is actually examining the documentations which you are submitting under the automatic route. That is actually before submitting form EC, there is a form called form ECB. That will be examined by AD Bank, and there will be a loan agreement between the lender and the borrower. This loan agreement not required to be submitted to the AD Bank, but the terms of that will be entered into the ECB. And payment for raising the ECB will happen only after the issuance of a loan registration number from the RBI. So once we submit this application form, AD Bank will examine it and will issue a loan registration number or LRN number, which is actually the trigger point for you to raise the money in the form of ECB. Without getting this LRN issued, you are not allowed to raise the money in the form or bring in any drawals to India. And there is a requirement to file a monthly return called ECB 2 monthly return, and that is to be filed within 7 days from the closure of the previous month, which is to be certified by a practicing company secretary or a chartered accountant, and it is to be filed through AD Bank. So there is a scope for practice in this also, but when you are certifying this kind of documentations, which is having a foreign exchange exposure, have to be very careful with respect to the terms, with respect to the compliances. Otherwise, as we are seeing after some time, there is any non-compliances is getting reported to the Directorate of Enforcement, and the person who is certifying it will come under the scanner for any non-diligence. And LRN shall be issued for each ECB. There are maybe multiple ECBs for a company. For each ECB, you need to have an LRN, similar to FDI. And when it comes to eligible, what is the cap of it? So we will see the term eligible borrowers or recognized lenders in coming slides. So the persons who are eligible borrowers can raise ECB up to $750 million or equivalent per financial year. It is not an overall limit, it is a per financial year. You can raise up to $750 million. So up to that $750 million, obviously it is automatic. Then it is beyond 750, it is approval route. And foreign currency denominated external commercial borrowings, that FCI denominated ECB from direct equity holder. We will see the terminology of direct equity holders definition specifically. So ECB, the direct equity holder, is also a recognized lender. And if the company is borrowing money in foreign currency from a foreign equity holder, we have to observe the ECB equity ratio of 7:1. If this particular ratio is not met, then it requires approval. And the ratio is not applicable if the outstanding amount of all ECB, including proposed one, is $5 million. So if the limit is lesser, then the ECB liability to equity ratio not to be complied. Otherwise, we need to comply. And borrowers are also governed by debt equity ratio of the sectoral regulator. So these are the automatic route. And we will see the particular concept of ECB liability to equity ratio in the coming slides before getting into the automatic approval route. So what is actually ECB liability to equity ratio? ECB amount include all outstanding amount of all ECB other than Indian rupee ECB. So whatever is the total outstanding foreign currency ECB, we will add along with the proposed ECB also will be added. So only INR based ECB will be excluded. When considering the equity portion, we will take the paid up share capital and free reserves, including share premium received from in foreign currency. So that is normally a definition of the foreign currency here. Only the proportionate. We will take the proportionate share premium received from foreign currency, and we will see these figures will be taken based on the latest audited financial balance sheet of the company. And both the ECB and equity ratio will be calculated with respect to the foreign equity holder. It is not specifically debt equity ratio. It is an ECB equity liability ratio, where it is calculated specifically to the foreign equity holder. If more than one foreign equity holders are there, sometimes there will be more than one foreign equity holders will be there. The portion of the share premium in foreign currency brought in by the lender concerned shall only be considered for calculating the ratio. So the other portion, that means the foreign currency premium, share premium brought in by the other foreign equity holder will not be considered, only for that particular one person. That is in case when there are more than one foreign equity holders. INR and ECB is to be excluded from denominator while computing the ratio, which we have discussed a while before also. That is to be excluded. And the ratio does not apply if ECB raised from an indirect equity holder or a common parent. That this indirect equity holder as well as a common parent is also considered as a foreign equity holder. But if you are borrowing, the ECB is being raised from a indirect equity holder or a common parent, this liability ratio need not be looked into. Now we will see a few more information about the ECB to equity liability ratio. So non-convertible preference shares are not considered in the equity component. When you are calculating it, this equity component shall be reduced by the non-convertible preference shares and debit balance in the profit and loss account to be deducted from the equity. And that is actually opposite to the free reserves. That is all applications are same. Only thing is that here the preference shares will not be considered as part of the equity component. And we will see now the approval route of it. In the automatic route, when there is a foreign equity holder, we have to ensure this debt equity ratio. From other sources, we don't have to look into the debt equity ratio component. So not the equity, ECB equity ratio component. And approval route is any amount exceeding 750 million US dollars is under the approval route. And in that case, for an ECB or any approval route requires prior approval of the RBI. No, it's not a post facto. The application to be submitted in form ECB to the RBI to the AD bank. The AD bank is the intermediary and we have to submit it to them. And application may be approved or it may be rejected based on the merits of the application. They will look into the several aspects before granting the approval. And there is a separate empowered committee to review the applications. And finally, if everything is fine, LRN will be issued and ECB2 is to be filed as in automatic route. And the rest of the compliances are same, only the entry barrier is different. Now we will see the two types of ECB which we have mentioned before. One is called foreign currency denominated ECB in any foreign freely convertible foreign currency like US dollars or euro. And INR, rupee dominated ECB in Indian rupee. These are the currency of borrowing. You have an option to borrow the money in either of these, and repayment should also be to be tweaked accordingly. Otherwise, and if it is a foreign currency denominated ECB, the repayment should be in foreign currency. If it is in rupee dominated, you have to pay it in rupee, and hedging, as we discussed before, to be ensured. So what is in case of foreign currency denominated, these are the forms of ECB. One is that loans including bank loans and floating rates, interest or fixed rate notes or bonds, other than compulsorily convertible debentures, all debentures, trade credit beyond 3 years, foreign currency convertible bonds, foreign currency exchangeable bonds, and financial lease. These all forms part of foreign currency denominated ECBs. So trade credits we have seen in detail. Up to 3 years we have seen that also how it is outside the scope of ECB. And when it comes to in rupee denominated, it is actually loans including bank loans, floating or fixed rate bonds, debentures, preference shares other than compulsorily convertible instruments can be in the form of INR denominated ECBs. Now we will see the concept of eligible borrowers and recognized lenders. Who is an eligible borrower? So in case of a foreign currency denominated ECB, all entities who are eligible to receive foreign direct investment is also eligible to receive the ECB also. So the criteria is actually coming out from the FDI policy. If you are able to receive FDI, you are eligible to receive the ECB also. And apart from that, Port Trust, units in CES, SIDBI, Exim Bank of India, all these entities are also eligible borrowers who can borrow under the ECB policy. In case of a rupee denominated ECB, all entities eligible to raise ECB, sorry, it is actually FDI, and registered entities engaged in microfinance activities, namely NGOs, trusts and societies are actually eligible borrowers in case of INR or rupee denominated ECBs. And if you see who can avail the FDI, companies, of course, partnerships or proprietorship with certain conditions, limited liability partnerships. Trusts are basically not allowed other than for the alternate investment funds and investment vehicles and startup companies. These all are the companies, entities which are eligible to avail these FDI. So these all are the entities which are eligible to avail the ECB also. And we have already discussed it. Port Trust units of CES, SIDBI, and Exim banks are also classified as an eligible entity. And if you see the rupee denominated one, Section 8 companies, specifically registered societies, registered trust, and cooperatives, NGOs, it's basically a repetition of what I have mentioned before, more specifically given certain names, Section 8 and all, are eligible entities. And specifically, these entities are engaged in microfinance activities. So otherwise, it is not allowed. On the other side, we have to see who all can lend money to the company, who all are the lenders recognized by RBI for extending an ECB to an eligible borrower. The lender should be a resident in FATH or Financial Action Task Force or IOSCO compliant company, country, and multilateral or regional financial institutions where India is a member country like ADB, or individuals as lenders can only be permitted if they are foreign equity holders or for subscription to the bonds or debentures listed abroad. So individuals can be a lender, but they have to be a foreign equity holder. And foreign branches or subsidiaries of Indian banks are permitted as recognized lenders only for foreign currency denominated ECBs, except that FCCBs and FECBs. So if Indian bank is having a branch abroad or subsidiary abroad, they can be a recognized lender, but they can lend it in foreign currency. And we will see the definition of foreign equity holder because it's having certain kind of, because an individual can lend money, but they have to be a foreign equity holder. So who is a foreign equity holder? So a foreign equity holder with a minimum 25% direct equity holdings in the borrowing entity. It's very clear, 25%. And equity holder with a minimum indirect holdings of 51%. Group company with an overseas parent. There is a common parent. And foreign equity holders' holdings should continue throughout the tenure. By the time of extending, they are the holder, and they should continue to be in this 25% or 51% or group company status throughout the tenure of the ECB. If you are changing the shareholding pattern below this limit, then actually you are contravening the provisions of the ECB guidelines. So we will see these two concepts which I have discussed for financial ask that the lender should be from any of these countries. Only that country should be a member of the Financial Action Task Force or a member of a FATF style regional body. A country should not be identified as a jurisdiction which is having potential money laundering activities are happening, and it's not, if the country is not committed to an action plan developed to address its deficiencies, then that country is also not classified as a country in which recognized lender can come in. And country should not be a signatory of the International Organization for Security Commission, and is based on it is actually ensuring the exchanging of the data, wherein SEBI is also a signatory. So these are the countries from which the recognized lenders are actually allowed to invest or to lend money to an Indian counterpart. Now we will see the minimum average maturity period, which is also a determining factor for the ECB. Largely or generally, the minimum average maturity period MAMP is 3 years. Before that, you cannot repay. It's a minimum average period. And ECB raised by manufacturing companies up to 5 million per financial year. Suppose if the manufacturing, it's a manufacturing company, and ECB is for a period of $5 million, and you can have the minimum average maturity period of 1 year. And ECB from the foreign equity holder, and that means we have discussed the foreign equity holder, and that money is getting utilized for working capital purpose, or a general corporate purpose, or repayment of a rupee loan. So here itself, the end users are clearly known. One is that money can be utilized for the working capital purposes of the corporate or general corporate purpose or for the repayment of a rupee loan. The minimum average maturity period is 5 years. And the ECB is raised for working capital purpose or general corporate purpose. That means other than from the foreign equity holder, or for on lending by NBFCs for working capital or general corporate purposes. Then the minimum average maturity period is 10 years. And ECB raised for repayment of rupee loans availed domestically for capital expenditure. Suppose a company had availed a loan locally, the rupee loan from an Indian bank or financial institutions, and the purpose of raising the ECB is to repay this rupee loan, provided the rupee loan is spent for the capital expenses. The minimum average maturity period is 7 years. Same is in the case of the NBFCs, that on lending purpose is also for this capital expenditure, and the borrowed money is being utilized for on lending for that purpose. Then also the minimum average maturity period for that ECB is 7 years. And ECB raised for rupee loans availed domestically. Same before, domestically for general commercial purpose or for on lending, it's a 10 years time period. So these are the minimum average maturity period, and we will see what is actually a minimum average maturity. So these are the, when you are availing the loan, you can utilize it based on the purpose for which you are using, and based on the person which is actually lending. Based on this, the minimum average maturity period will change, and this should be captured in the ECB 2 letter, ECB 2, as well as the ECB forms which we are filing for the approvals or for the automatic intimations. And the minimum average maturity period is like call and put options, if any, shall not be exercisable prior to the completion of the minimum average maturity period. That means lender cannot call back the money, or the buyer cannot prepay the money prior to the completion of the minimum average maturity period. And the prescribed minimum average maturity period will have to be strictly complied in all the circumstances. This is one of the criteria. This is a restrictive clause wherein you cannot change the minimum average maturity period within that as prescribed. You cannot do the non-compliance in that aspect. And now we will see the all-in cost. So we have seen initially itself, we have seen that the minimum average, the ECB comes with a lot of parameters. So minimum average maturity period is a parameter. Eligible borrower is a parameter. Recognized lender is a parameter. All-in cost is the next important parameter. So maximum amount of cost that can be borne by an Indian borrower, that is called covered, and that is borne by the Indian borrower, which includes rate of interest, other fees, expenses, charges, guarantee fees, ECA charges. All these things encompasses the minimum, the maximum amount of cost that is being borne, and it is included in the all-in cost. So your cost of the fund should be inclusive of all these things. And it does not include commitment fees. Commitment fees is basically a fee charged by the lender. It's a fee charged by the lender to the borrower to compensate the lender for its commitment to lend. That if there is such a commitment fees is being charged by the lender, that will be over and above this cost. And withholding taxes payable, if any, will also be over and above this all-in cost ceilings. So other costs, like there will be some prepayment charge or penal charge for default, or in case of a breach of covenants, there will also be a penal charge. In that case, that should not be, the charges should not be more than 2% over and above the contracted rate of interest and on the outstanding principal amount, and will be outside the all-in cost ceilings. So any other cost, like the penal charges, will be outside, but there is a cap for it. And ECBs or trade credits proceeds cannot be used for the payment of interest charges, payment for the interest charges of this loan. So you are availing the loan, and the same money cannot be utilized for the repayment of the interest or charges. But if the loan is being availed for a project finance, which is during the construction stage, you can use this money to service the interest. Otherwise, this money cannot be utilized to service the interest of the ECB. That is also a restrictive clause in it. So if you see the all-in cost ceilings per annum for a foreign currency denominated ECB, the benchmark rate, earlier it was London Bank prime renting rate, LIBOR was there. Now it is benchmark rate plus 500 basis point spread. And for INR based ECB, it is actually 450 basis point spread. That is the all-in cost, in which we have seen that what are the costs which can be included and which can be excluded. And then this all-in cost should be within the applicable ceiling all the time. You cannot surpass it, and averaging of the costs between years are not permitted. That means you can charge an extra amount a particular year and which can be reduced next year and adjust it and average it. That is not allowed as per the ECB policy. And we will see the benchmark rate. Benchmark rate in case of a foreign currency ECB is actually refers to a widely accepted interbank rate or ARR of a month of a 6 months tenure applicable to the currency of borrowing. So it's basically an interbank rate which is fixed internationally. And in case of an INR based prevailing yield of Government of India securities of the corresponding maturity. If it is for 3 years, that period of government yield, what the government security is giving yield, that will be taken. This is a benchmark rate plus 500 basis point spread or 400 basis point, 450 basis point spread for the INR based. So these are the all about the all-in cost ceiling part of that's a parameter for the ECB. Now we will see the restrictive that clause, which is called end-use restrictions. It's a negative list stating that ECB proceeds should not be or cannot be utilized for these kind of activities. One is a real estate activity. What is the definition of a real estate activity means? Real estate activity is simply, actually you can say that buying and selling the land without any kind of value addition. That is basically a real estate activity. It is an own or lease property for buying, selling and renting of commercial and residential properties or land. However, the real estate activity does not include construction or development of industrial parks, integrated townships, or purchase of long-term leasing of the industrial land as a part of a new project. Any activity under the infrastructure sector definition. It's almost similar to what is mentioned in the FDI policy with respect to the infrastructure construction development projects. So other than this, any activity will be classified as a real estate activity, which is not allowed. That means your ECB proceeds cannot be utilized for that. And then if ECB cannot be utilized to invest in the capital markets, obviously we know the reason. And because cheaper funds will flow and it will tamper the market. And equity, it cannot be used for equity investments. And working capital purposes, which is except as permitted. In the previous slides, we have seen that working capital purposes, it can be utilized, but provided with a certain minimum average maturity period and from specific sources. Similarly, general corporate purpose also, you cannot utilize it except as permitted. And you can repay the rupee loan as permitted. And on lending to entities for the above activities, that is also not allowed. You are lending the money to another company which is doing real estate activity, or you are lending the money which is actually doing some kind of capital market investments. These are not obviously not allowed, and it is actually trigger investigation, or the contravention will trigger investigation unless duly explained. And the hedging provisions here is also mandatory to get it hedged because of the currency rate fluctuations, and it is mandatory to follow the guidelines for hedging by the sectoral regulators or prudential regulators, similar to that of what we have seen in the trade credits. And infra companies shall have an approved risk management policy. And ECB borrowers have to cover the principal and coupon rate, that is the interest rate, through the financial hedge. Whatever your outflow to be properly hedged, and a minimum tenure of 1 year with a periodic rollover. That means that the period that you need to renew the hedging for forward contracts. And such companies are mandatorily hedged 70% of their ECB exposure in a minimum average maturity is less than 5 years. So at least 70% of the ECB exposure to be hedged. And it's similar to what we have seen there also in the ECB trade credits, because permissible to if you want to change the currency of borrowing subsequent to the borrowing, it is if it is a foreign currency convertible bonds FCA foreign currency ECBs, then it is permissible to change from one freely convertible foreign currency to another freely convertible foreign currency. In case of an INR based ECB, is actually change of the foreign currency from INR is not permissible. And there is when we have studied the types of ECBs, we have seen that ECB can be availed by the startups. As startups is of interest and the government of India is giving more prominence to the startups, there are certain relaxations or certain that additional benefits for the startups which are availing ECBs. We will see that also. The entity, first of all, should be recognized as a startup by central government under the Startup India notification. And the minimum average maturity period is 3 years, irrespective of the usage. We have seen that for the capital goods and non-capital goods, it is different, or for the type of the end users, it is different. But in case of the startups, it is 3 years. And recognized lender is same as in other cases. We have seen the recognized lenders. And borrowing, when it comes to borrowing, loans or non-convertible or optionally convertible or partly convertible preferences can be the mode of availing the loan or the money. So any of these instruments can be utilized for this. And currency, and if it is actually a non-convertible instruments also covered, which is not in the other cases. And you can the startups can borrow in foreign currency as well as in rupee loans. And the amount is $3 million per financial year for INR as well as foreign currency related or a combination. So you can the ECB, they are given certain kind of relaxation which is not there for the other kind of eligible borrowers. And if you see the startups all-in cost, is actually what is stated that is mutually agreed by the parties. That means there is again a relaxation given to the startups with respect to the all-in cost. And end users also for any expenditure in connection with the borrower's business. There is largely it is open. We're stating that any expenditure in connection with the borrower's business and a conversion to equity is freely permitted subject to regulations. And if you see the security part of it, choice of securities left to the borrowing entity. That means to the startup. Of course, the lender will also have a say in that, but regulations state that it is a choice of the borrower. And INR ECB to be hedged through permittive derivative products with the AD bank. So hedging for the INR ECB is also there. So these are the certain relaxation which is given to ECB being availed by the startups, which is actually quite interesting when comparing to the other type of borrowers. Now, we know that there are trust assets in India, like it is, as I in the beginning itself I mentioned, SMA2 or NPA, non-performing assets classified loans. Those loans can be repaid or refinanced using the proceeds of the ECB. RBI have come up with a circular in 2019, which is allowing the ECB to refinance trust assets in various ways. One is the resolution applicants and entities in CARP can raise ECB. I hope that the persons or members who are attending or students who are attending this seminar is aware about the CARP. CARP is a process through which a debt of a company or a corporate person is getting resolved based on a resolution plan being submitted by a resolution applicant. Once a resolution applicant is coming up with a revival mechanism, that in adjudicating authority, that is National Company Law Tribunals and the Committee of Creditors will look into that and approve the resolution plan if it is feasible. On feasibility, on approval of the plan will become binding on all the stakeholders. So in order to regularize or to revive or rejuvenate the corporate debtor, that is a corporate person undergoing CARP, the resolution applicant or the entity itself have to borrow money from abroad or from the Indian sources or from the promoters. So in this case, if the company is facing CARP, a resolution applicant can avail ECB to bring their part of the performance to the entity, or this entity itself based on a approved resolution plan raise ECB. So that is a change which is made into the ECB guidelines. Entities in restructuring process or CIRP can raise ECB only if permitted in the resolution plan. That means the corporate debtor which has undergone the CIRP can avail the ECB if there is a specific clause in the resolution plan. Eligible borrowers participating in CIRP as resolution applicants can raise ECB from recognized lenders also. So that is actually coming under the approval route. It is not an automatic route one. So you have to get the approval of the RBI for invoking this particular clause. And is again refinancing of the stress entities or manufacturing or infrastructure with the domestic rupee loans classified as SMA2 or NPA can avail ECB. As I had mentioned in the initial stage itself, in India, there is a norm that if you are facing this kind of issue because your asset is getting classified as an SMA2 or eventually becoming a non-performing asset, then no other banks will be willing or financial institutions will be willing to extend you further financial assistance to tide over this difficult situation because of the stringent RBI policies. However, these companies, entities in manufacturing or infrastructure segment can tap the possibility of availing an ECB from abroad and settle these particular liabilities and regularize the financial stress facing by them. And ECB can be used to repay the default amount. And lender banks can assign such debts to eligible lenders after complying with the ECB norms. So the lender, it is responsibility of the lender also to assign, to see that the borrower is complying with these ECB norms to settle the lender's liability. The eligible borrowers who are resolution applicants under the IBC can raise ECB to repay the rupee term loans of the target company. Such ECBs are under the approval route. Sometimes as part of a resolution plan, the prospective resolution applicant have to settle the certain liabilities of the financial creditors. In that case, financial creditor have to be given money to to complete the process, and that money can be taken by the eligible borrowers who are the resolution applicants under the approval route. And there are entities which are actually coming under the investigation, and whether these type of entities can avail ECB when they are under the scanner. The answer is yes, and that they can avail raise ECB. Only thing is that the borrowing entity shall inform the pendency or investigation or adjudication or appeal to the AD category 1 bank as well as to the RBI. And RBI or AD bank shall intimate the concerned agencies. If it is Directorate of Enforcement, they will inform them, concerned by endorsing a copy of the approval letter. So the investigation is not a bar for an entity to raise the ECB, provided they are getting adequate approvals from the RBI through the particular agency. And there is a concept called untraceable entity. You are availing ECB, then you are simply gone absconding, or you are not responding to their queries, or you are not replying to their emails, or the promoters or directors or auditors are not reachable. Then you will be classified as an untraceable entity, provided these two conditions are fully complied with, fully met. Like one is that entity not found to be operative at the registered office as per the records of the AD bank. How they will find that you are not operative? Because they will have to conduct a physical inspection. During that inspection, the office is not functional. They can say that the entity is not operative, and entities have not submitted the statutory auditor certificate for the last 2 years or more. If these two conditions are cumulatively complied, then your entity can be considered as an untraceable entity. And the consequence is that if you want to revise it, you have to file if I revise the ECB and last ECB 2 return, that is a monthly return, without certification from a professional, with the untraceable entity written in bold on the top, you can revive your status to a traceable entity. And outstanding amount will be treated as a written off from the country's external liability, which you have seen that it is a liability of the country. So that liability, whatever the money which is borrowed by this untraceable entity, will be considered as a written off in the books, and no fresh application from the entity shall be entertained because you have already become untraceable. and enforcement director shall be informed. The non-filing of the returns can result into this. And no debt servicing or inward remittance shall be further allowed under the automatic route. So these are the consequences of becoming an untraceable entity. And whether the ECB can be used to refinance the ECB or one existing ECB. You already have availed an ECB that is unserviceable, or you want to have a better ECB which is available, that can be possible. Refinancing is possible by availing a fresh ECB. Outstanding maturity of the, it should not be that the total maturity period should be within the limits of the original ECB. You cannot extend the average maturity period by availing a fresh ECB to refinance the original one. So it should be same. And all-in cost of the fresh ECB should not be should be lower than the existing ECB. It's a negative condition. Basically, all-in cost should be lesser, should not be more. And so if it is so, refinancing is possible, and raising fresh ECB to part refinance the existing ECB is also permitted. So partial refinancing also possible. Only that is possible. That is allowed only for the Maharatna companies or Navaratna companies or highly rated, that is AAA rated companies. So refinancing is possible. Under the ECB, the companies under investigation is possible. And for meeting the liabilities, means default liabilities is possible. To finance the CARP, the commitments are possible. So these all are possibilities. And we will now see how the money to be bring into the company, whether money can be parked abroad for a certain period of time before you are getting utilizing in India. That is called parking of ECB proceeds. So it is permitted to park the ECB proceeds abroad, or you can bring the money to India and park here domestically, but with certain ifs and buts. So parking abroad means ECB meant only for foreign currency expenditure can be parked abroad pending utilization. So if your ECB is a foreign currency ECB, then only you are allowed to park it abroad pending utilization. But it can be, you can invest that in deposits or certificate of deposits abroad. Other products offered with a rating not less than AA minus, treasury bills and other monetary instruments of 1 year maturity, deposit with foreign branches or subsidiaries of Indian bank abroad. In these instruments or with entities, you can park your money if your currency is a foreign currency ECB. If it is a domestic one, ECB is meant for rupee expenditure. Rupee expenditure should be repatriated immediately to the credit to the rupee account with the AD bank. If your purpose of the ECB is to meet the rupee expenditure, you cannot park abroad. You have to bring the money to India and keep in the AD bank. And you are allowed to park in the term deposits for a maximum period of 12 months cumulatively, and it should be kept unencumbered. No liability or no lien should be marked on that particular money which is parked domestically. And whether this ECB can be converted into equity, it's a possibility. Conditions for conversions of ECB including matured but unpaid. If it's a maturity, you have reached the maturity of repayment but is still unpaid, activity should be covered under first of all, the activity of the company or the borrower should be under the automatic route or the approval route. That means as per the FDA policy. And the lender consent is a prerequisite. Whoever has given the money have to give a consent to you, and should not result in contravention of the eligibility or breach of applicable sectoral cap of the foreign equity holding under the FDA policy. We have to peruse the FDA policy and see that whether this is within the limits prescribed under the FDA policy, and applicable pricing guidelines of the shares as mentioned in the FDA policy to be complied with. If it is so, you can convert your ECB into equity. And the partial conversion as well as full conversion is possible. In case of a converted portion to be reported in FCGPR, the converted portion to be reported in FCGPR, and remaining portion to be reported to the Directorate of Statistics DSIM in the form ECB2 for the unconverted portion. So converted portion you will be considered as ECB, and other one will go to the Statistical Department of RBI. And full conversion, in case you are converting your ECB fully into equity, then entire portion to be reported to the RBI in form FCGPR, that is the reporting format. And ECB 2 with remarks ECB fully converted into equity. If it is, you are intimating that ECB is fully converted into equity, then no more ECB 2 filing is required. So ECB can be converted, it can be partially converted, it can be fully converted. Only thing is that you have to comply with the FDI policy of India and pricing guidelines. And if the borrower concerned availed of other facilities from Indian banking system, guidelines on restructuring to be complied with. So there are other facilities. The borrower is actually having other facilities because you may have to follow the restructuring guidelines of the as per the Indian banking system. And there are other lenders. The consent of the other lenders is also needed because it may affect your debt equity component, and all those things will be changed so that or a control aspect is getting changed because another promoter or a major shareholder may comes in. So all these things may affect the interest of the other lenders who are in the picture. So their consent is also needed. And conversion of ECB dues into equity, the exchange rate prevailing on the date of agreement of such conversion be applied. So whenever you are going to convert, that is what is the prevailing rate, exchange rate on that date of conversion will be considered, and that will be applied for the conversion. And fair value of the shares shall be arrived at based on the date of the conversion. On that date, we have to arrive at the conversion rate of the loan as well as the value of the shares. Now, we have seen most of the parameters with respect to the ECB trade credits as well as the structured obligations. Now, we will see the procedure for raising the ECB. Only few more slides to go, and I will conclude after that. We will go for the question and answer session, and I will try to answer based on my limited knowledge. And what are the procedures for raising ECBs? That we have seen that it is allowed under the automatic route as well as in the approval route based on the, we have a detailed discussions on that. And now the reporting requirements, is a loan registration number, LRN number is needed. Any drawdown is permitted only after obtaining the LRN. Unless you get an NRN, there is no possibility to raise this money, to draw down this money. And to obtain LRN, form ECB in duplicate to be submitted to the AD bank, and copy of the loan agreement need not be submitted. And the changes in the ECB terms and conditions should be reported to the Department of Statistics and Information Management, DSIM. This should be reported. And revised ECB to be filed within 7 days from the date of changes affected. So whenever there is a change in the ECB, like you are going to convert it or you are going to partially convert it, you have to file the revised ECB within 7 days from the date of the changes. And there is a monthly reporting is there. ECB 2, I have mentioned that CA or CS to certify, and it's basically going on a monthly basis on the closure, from the closure of the month within 7 days. And there is a late submission fee is there. In case if you are delaying it, by up to 30 days, the fee is 5,000. From 30 days to 3 years, it is it's actually 5,000 per year. And beyond the 3 years, it is 1 lakh. Second figure seems to be a mistake from my end. I need to recheck that. So anyway, beyond the 3 years is 1 lakh per year. And what are the powers? What are the powers with the AD bank with respect to the ECB is that subject to the NOC of the AD bank, you can change the AD bank. You can change from one bank to another. And bank may directly approach this DSIM for the cancellation of the LRN if you are not complying with this. That is so that responsibility falls on the shoulders of AD bank also. So the compliance responsibility is primarily on the borrower, and designated bank is also expected to ensure the compliance with the ECB guidelines. So anyway, the answerability remains with the borrower, and AD bank can cancel your LRN by informing the RBI. And there are certain things to remember, to sum up certain things we have to remember. One is that foreign currency loans given domestically from FCNRB are not an ECB loan. That means a foreign currency non-resident account, rupee account, if you are maintaining that if the banks are giving foreign currency loans from that will not be considered as an ECB loan. That is a normal loan. And borrowing from non-residents has to be in compliance with the ECB guidelines. There is a prevalent practice that there are so many non-resident Indians are there who are actually investing into shares of the company on a non-repatriation basis, which is actually allowed. non-repatriation by PIO as well as OCI is allowed, as well as NRI is also allowed. But when it comes to the borrowing side of it, there is an absolute lack of clarity whether we have to comply with the deposit foreign exchange management deposit regulations 2018 or the ECB guidelines. Apart from these compliance, these two things, whether a Indian person, Indian director who is a non-resident Indian can bring in money to the Indian company as a loan without contravening is a question which is to be examined. ED is actually issuing notices in such cases where they are stating that you have brought in the money as a liability or a director's loan, you have not complied with the deposit rules or you have not complied with the ECB guidelines. And even though the money is not on non-repatriation, is on non-repatriation basis, you have to comply with either of these guidelines. Otherwise, you are ready to get compound or get punished for the offense. So basically, borrowing from non-residents has to be in compliance with the ECB guidelines or the deposit regulations. And the structures that bypass, circumvent the ECB in any manner shall result in contravention of the ECB. You are creating a structure to circumvent the ECB in a way which is convenient to you, that is very prone to get investigated, or you may be liable for contraventions. And reimbursing expenditure incurred in the past is not a permissible end use for the ECB framework. That there are that except for the rupee loans, whatever the expenditure you have incurred in the past, that cannot be paid using the ECB proceeds. And ECB proceeds can be utilized for overseas investments as permitted under the overseas investment guidelines. So you can use this money to invest abroad under the overseas direct investment policy of India. You can use it for the further investments. But there's a contradictory statement in the other way, stating it should not be used for the equity investment. But this overseas direct investment is permitted. And refinancing of rupee-dominated ECB with foreign currency denominated ECB is not permitted. So if you want to refinance the rupee-denominated ECB, you have to avail another rupee-denominated ECB. You cannot have it repay it with a foreign currency-denominated ECB to repay your rupee-denominated ECB. And on-lending by borrowers who are engaged in the business of on-lending is not treated as a working capital. These are all a summary of what we have discussed, but still, on-lending by the borrowers who are engaged in the business of on-lending is not treated as a working capital. You cannot say that I have used it as a working capital because that's a separate segment. You cannot use it. In the light of new ECB framework, the borrower is not required to revise the form ECB. There is a change in the ECB guidelines, and in that ECB guideline, due to that guidelines change, you don't have to revise your form ECB. And late filing fees, late submission fees is applicable for non-submission of each ECB2, including nil return. So even if there are no drawdowns, no repayments, or no transactions, you are supposed to file the ECB2 in a timely manner within 7 days of the close of the month. If you are not transactions, you have to file nil returns. Otherwise, the penalty or late submission fees will become applicable. And fixed deposits created out of ECB proceeds pending utilization be renewed after completion of the pending utilization be renewed after the completion of the maximum permitted period. So I have fairly covered almost all the aspects with respect to the ECB, trade credits, and the structured obligations. And I am concluding my presentation with this. And now I think floor is open for any questions. I am just winding up my presentation. Thank you very much for the patient listening.
Thank you so much, sir. It was indeed very comprehensive, detailed, in all sort of manners. So I'll be beginning with the questions, and it's not in any arranged manner, whether it's trade credits or ECBs. I'll be just taking it on the way.
Yes, if it is within my knowledge, I will answer.
Definitely, I'm sure of that. The first one that we have is whether trade payables or trade receivables of foreign parties, related or unrelated, are required to be reported in FLA return. If yes, where?
It's actually, FLA is technically dealing with the foreign direct investments. This is with respect to the ECB.
So this won't count.
It will not cover. FLA is not covered under the ECB. Here, whatever the compliances or whatever the drawdowns or repayments or the payment of the interest are basically governed or regulated through a form called ECB 2. Now it's known as ECB. It was ECB 2 earlier. So that is FLA is plainly applicable for foreign direct investments and its annual returns.
Sure. How we have been talking about the minimum average maturity period in all the categories.
Yes.
How is it calculated?
So minimum average maturity period, I have seen that. I have made a separate slide for that, like for 1 year period, 5 year period, 7 year period, 10 year period. All those periods actually depending upon the eligible borrowers categorization or the foreign equity lender if he is giving the money, and for the purpose for which it is getting used, working capital purpose or general corporate purpose, or whether it is being taken by a manufacturing entity or for the financing industry. Depending on this maturity period will change, and this period will be calculated from the date of availment of the loan. It will that is the importance of that particular slide. It was actually specifically stating what is the maturity period for each kind of remittance, and depending on how you are going to use it.
The question was more about the procedural aspect. I guess when somebody had put it, how it is the formula for calculating it.
So I am not 100% sure about the formula part of it. It's more into the legal aspects of that.
No problem. There are two questions which have come in a similar manner, so I'll be taking that. Can advances received against the services rendered by an Indian LLP to its holding company outside India under the service agreement executed between them be considered under ECBs?
That means you have provided certain services to a person abroad, and there is a payment is due against that. That payment is due against it. Basically, it is a trade credit up to a period of 3 years time period. If you are going beyond the 3 year time period, it is actually covered under the ECB, wherein you need to get all the compliances done for that. So, yeah, please.
No, please, you go ahead.
Yeah. So, depending on the nature of the service, because you are definitely, it is a capital account current account transaction, which you have provided service, but the amount is payable. You want to convert that into a loan. That is exactly what we have discussed so far. It is possible.
Okay. And where there is a default in making payment or there is an inability, what are the repercussions of such transaction, and what is the remedy that can be taken to write off bad debts?
With respect to we have discussed about the supplier's credit as well as the buyer's credit earlier. If it is a buyer's credit, in that case, there is a financial insurance involved. Like you are involving a bank to ensure your payment. Before you are making the services, you will ensure that your payment is coming to you through the bank which you have been engaged to. In that case, if you are not getting that payment from it, we are actually, when this is a reverse of the ECB, you are the money which you are actually should come from them, right? You are not borrowing the money. You are actually providing the service to them, and they have to provide the money to us. It is actually reverse of what we have discussed on it. Right?
But then that again, the bad debts of that, because it's a foreign currency thing.
Yes.
How will that be recorded in the books?
But that is definitely not under the scope of ECB.
ECB and
trade credits. Because you have not availed the service, you have provided the services. And the money is actually due to him, due to a person resident in India, against a service which is provided to the other person. So the money to be recovered based on the other laws which is applicable. It is not covered under the ECB.
Okay.
It's just reverse of what we have discussed.
Again, now let's take the opposite of that. What if the repayment of ECB is not done within the scheduled time, and if the schedule is not rescheduled? Do we need to compound the offense?
Yeah, see, there is it is possible for us to restructure the loan arrangements with the mutual consent of the lender. If there is a revision in the terms of the ECB, you have to file a revised ECB return, form ECB to the Reserve Bank of India through the AD Bank, intimating them the revised one. And in case the ECB availed and you are not unable to pay, you can even include a clause to convert that into equity. Or you can go for a refinancing of it. these possibilities which we have discussed already. So the question is, you have a liability which you created, you're unable to meet that obligations. In that case, first of all, you will discuss with the lending bank and restructure your loan. And in that case, you have to intimate to a revised ECB out of file. Otherwise, you go for a refinancing options or restructuring options, all with the consent of the lender's bank as well as intimating to the RBI.
So in case where all of them are exhausted, where we're talking about the compounding of offenses, is there something of that sort available?
A compounding of offenses basically come for the non-compliances with respect to the same. Like you are not meeting certain criteria, like you are not an eligible borrower, you are not a recognized lender, you are not meeting the all-in cost ceilings, you are not complying with the security aspect of it, or you are not not filing the returns in a timely manner. All this will attract the contraventions. With respect to the non-payment of it, it's not specifically governed by the regulator. There is no mentioning about that particular aspects in the ECB guidelines. I don't know what that was a question or not. That was, anyway, I think that is what I understood from the question.
My next question comes in the ECB category. Is it mandatory to add the call and put in the ECB agreement?
Yes, it is possible. It is possible to have a call and put options, but you cannot invoke that before the average maturity period, minimum average maturity period. Suppose the minimum average maturity period is 3 years. Even though there is a call and put option in the agreement, you cannot invoke it. It should be only after this minimum average maturity period you can invoke it.
But is it mandatory to put it in the agreement,
yes,
or can we?
It is an agreement between, it is an agreement or a comfort between the parties. Even if you are having such a clause, you cannot invoke it during the, before reaching the minimum average maturity period.
Whether
if it is a foreign lending institution, definitely there will be this kind of clauses. But
yes.
invoking of that is actually should be as per the ECB policy.
Okay. The next question is whether general corporate purpose includes expansion projects.
That is a capital expenditure in nature, right? The general expansion project is not a general corporate purpose. It is basically an expenditure of capital in nature. Capital expenditure are allowed. General corporate expenditure as well as the corporate expenditure, these two are given. These are actually not an investment oriented one or capital intensive one. That is basically a revenue expenses in nature or a expenditure in nature, not a capitalizing one. So if you are going for a capital expenditure, definitely you can raise ECB for that if you meant by that.
If ECBs are in foreign currency and interest is accrued on it, will it attract withholding tax at the time of payment of FCECB?
Yes, it is withholding tax is applicable, and withholding tax is actually excluded from the all-in cost ceilings also. And that means your total cost when you are calculating, that the borrower will be incurring certain expenses for this particular liability. That is called all-in cost. Your rate of interest, your charges, everything. But withholding tax is specifically excluded from the definition of the all-in cost. If there is a withholding tax is required as per the Income Tax Act, you have to do that. Maybe as per section 195, I guess it is a maximum rate to be deducted for that.
So there's an ECB from a parent company with repayment of principal and interest after 6 years. The TDS liability will be borne by the lender. The borrower wants to claim reimbursement of TDS on interest to meet its working capital. Can it do so within the FEMA regulations?
Means borrower is the Indian entity.
Yes, so obviously ECB from parent company means that the borrowing is the Indian company.
Indian company. So TDS is getting deducted in India, right? And the PAN is of the parent company.
That's too confusing.
That's too confusing. Parent company is actually the lender. That means they are getting the interest. So interest TDS is getting deducted in India. How can the Indian company then claim the TDS? It's the parent company to claim the TDS. I think question is having certain confusing statements.
Yes. Actually, it's too vast for, to put in a single question.
See, suppose a Indian borrower is a foreign company, so lender is a foreign company. Then TDS is actually a money which is to be given to them. We have deducted and withholding it here. It is for them to file the income tax returns and get it. It is not for the Indian borrower to claim the refund of the TDS.
Okay.
Right?
Clarified.
Right. I think the question was on, I think some mistake in the question.
Yes. If the ECB is raised from direct equity holder, are we required to comply with the ECB equity ratio of 7:1?
Yes. 7:1 is applicable only when the money is coming from the foreign equity holder. Otherwise, that ratio, foreign equity ratio is not required to follow.
When the trade credit is extended beyond 3 years, does the company have to obtain LRN and then convert it into ECB?
Yes. It's an approval one. So you have to get the approval route. You have to go through the approval route.
Is there any cap for ECB amount from group company?
750 million is under the up to automatic route. 750 million is the up to automatic route. Beyond 750 million US dollars, it is approval route. So this is the cap.
What is the foreign ownership limits for a listed company doing stockbroking activities?
No, that is actually out of this topic. We have not even covered that one. That is about something else, totally different.
What is the benchmark rate and all-in cost?
A benchmark rate, which we have discussed, right, which is an interbank rate, international banking rate, plus the basis point spread, which we have discussed, 500 basis points and 450 basis points. Interbank, that you can search for the benchmark rate and get the current rate from the Google itself, because it will change, it will fluctuate periodically. The other rate, that 500 basis point, or that is 5% or 4.5% to the benchmark rate, is actually the proper rate of interest. So benchmark rate, you can always say, earlier it was LIBOR, now it is benchmark. Right.
Can a CS in employment sign or certify ECB2?
No. It is for the practicing.
Practicing. And linking to this one, I'll end with my last question. What are the opportunities available for company secretaries in this area?
See, when the law is complex, difficult to understand, there lies the opportunities, right? And we, the company secretaries, having that skill to understand these kind of complex regulations, this is opening the opportunities, not only in the certification of ECB. ECB is a certification which can be done by anybody who by checking this remittance details. But giving an advisory to a person who is in need of this money, suppose if you are after this seminar, you know that for a trust asset management, this can be used. Many of the professionals may not be aware about it. It is your client definitely will go through this, and you are the right person to advise him. And in case of a structured obligations, a guarantee is giving, you are simply giving a guarantee and you are invoking it. And these all are actually $1 million worth of answers, which can be given only by a professional like a company secretary. So I think the opportunity is unlimited under the FEMA specifically, because the law is very complex and is fast changing. When a law is complex and ever evolving, there lies the real opportunity. I think we should explore it.
Definitely. So on that $1 million note, thank you so much, sir, for being with us. Thank you so much for this insightful session. It was completely amazing. Thank you for being with us.
Thank you. Thank you very much. Looking forward for more such opportunities. Thank you.
Definitely.